Hey, welcome back to Compounding Wisdom with Gio and Jared. We got a new person in
Hey,
the house. Jared has been at Ludacka Wealth Partners for almost 16 years. This old guy here, and my best friend at work, and we work on the investment side. So always fun to have another investment person on the show. My friend, how are you doing today?
I'm doing great. It's Friday, beautiful weather outside, and I've been waiting to do this for a long time. So I'm grateful to get to join you, and hopefully I get to be on this more.
Oh yeah, for sure. And yesterday we had a blizzard here in Omaha, Nebraska. We had crazy weather this week. So it is in Nebraska. You kind of just take the blows. It was 65 degrees earlier in the week, and then the day of a client appreciation event at Blue Sushi, it stormed just a couple of hours before before the event, and but we still had a great turnout. Well, over 130 people showed up. So God bless them. We had a great time. It's kind of this idea of never let a good crisis go to waste. It's kind of like what Winston Churchill said, and we did not. We drove carefully, slowly, and we made it. Ate a ton of sushi. Had a great company, and just had a great time. Just kind of running into the storm, as we like to say, from a Buffalo mindset. Did you enjoy your time, Jared?
Oh my gosh, it was the best. I mean, we just have the best clients. Our team was amazing setting up.
Hmm.
It was beautiful setup, and yeah, I mean, up until 3 or 4 p.m., man, it was clear, and we thought we were uh, thought it was going to be a clear evening, but the snow came in, but we made the best of it, and it was an epic night. And
Yep, yep.
yeah, though I'm not a sushi guy, you're trying to convert me, and slowly but surely. But, I love Blue, love our clients, and I love LWP, so it was,
Yep.
truly epic.
Yep, yep. And we did have a snow day, so 2 days of no school. Jared and I have both 2 little kiddos. I have a 6-year-old and a 2-month-old. Man, so the 2-month-old was just sleeps all the time. Very, very different than the first one. The first one, she was jumping all over the house. And we actually have Jay, Jared's child, and
Yep.
my daughter, the oldest, Sydney, at the office. They're working alongside of us. But so that's what you have to do during snow days, right?
Oh my gosh, he was been looking forward to it, he loves to come into the office, so, yeah, snow days, they were running around today while we were doing calls, and, that's the modern work environment is kiddos are gonna be a part of it, but, yeah, he's been looking forward to coming to the office and, getting to play around, so.
Oh yeah, yeah. So that's super cool. Okay, with that, I do want to transition into the markets. Today on today's show, we are going to be talking about the health of the consumer, and the biggest retail companies out there are Walmart and Amazon. So we're going to talk about those two behemoths and some of the massive volatility that we're seeing in the marketplace. And we'll end as we always do with wisdom of the week. We're recording this on February 20th. It is 4 p.m. Central Time. Information that we share is subject to change. Let's get right into it. So I always like to look at Bank of America. Always shares really good insights. They have hundreds of millions of clients using their products, and so they have a ton of data that they share on their particular clients. So they just shared what their clients are doing from a consumer spending perspective. Here is a chart from just last month. This is just Bank of America internal data. And here we can see that total credit card and debit card spending growth per household grew almost 3%, which is essentially what we saw. It was a little bit higher than last month. I think the retail books came in December around 2.4%, 2.5%. And so, as you can see, just the consumer continues to stay resilient across all income growths. Obviously, there's more spending, more flexibility on the higher end. And that's what they show in this chart here. So they kind of break down the different cohorts between high income, middle income, and low income demographics. And on the left hand side, you can see that spending growth kind of everything is kind of coming down for middle and lower income. The higher income groups continue to spend mm, on a steady basis. On the right hand side, similar difference here, but here you're seeing wage growth. So higher income cohorts, they're actually seeing the highest wage growth, 3.7% year over year. And so this is a double whammy for the lower income group. So they're not able to spend as much. They're not getting as much income growth. And so this is just putting pressure on them. We listened to the Walmart earnings call, which kind of wraps up Q4 earnings season, and they saw that the biggest growth um, came from those households that were making $100,000 or more, and those that are making about $50,000 or less. They do see a little bit of pullback there. So you kind of see a little bit of that K-shaped economy continuing, that will continue to happen when 10%, the top 10% of Americans are contributing to 50% of the consumer spending. So that will continue to be a thing. Last one here from Bank of America, just showing just rent payments continue to grow faster for lower income households. That's what you see on the left hand side, and so they're making less money. The rents are higher, and obviously from just like um, you know every dollar that they lower income households receive, they tend to spend more of it, but just because the necessity bucket, they most of that money is going to towards that. There's less discretionary spending there. And then on the right hand side, for a quarter of lower and middle income households, rent is half of their yearly income. So again, more pressure on the lower income. That's what Bank of America is showing. Your thoughts on this data, Jared?
No, and, I mean, that's what we've been seeing in the data, rent, and that's what I think the administration and just, policymakers are trying to combat is, "Hey, how do we make it more affordable?" Because, the lower end's just getting squeezed, so, yeah, super fascinating, and, I'll be curious, what the next interest rate cycle looks like because I think they
Oh,
might be coming down and, hopefully that'll, be helpful for some of these, but yeah, interesting
yeah.
data.
This was another data point that I just saw from Apollo. Torsten Slack, really good charts that he always shares on his daily Spark newsletter. But here we're seeing that even though I think in our last segment we talked about how people are continuing to spend more, putting more on their credit cards, delinquency rates are increasing a little bit from the credit card space. But when you that's only looking at one coin, one side of the coin, so to speak. So when we look at just the asset piece, um, there's just more assets that consumers have on their balance sheet. So Torsten Slack shares household debt as a percentage of GDP, and you can see here that continues to trickle down from the dot com bubble, from financial crisis, and so this is a good thing. This is a good trend.
Love to see this.
Yes. The two big retail companies, the biggest ones in the world, Amazon and Walmart. Again, as we mentioned, Walmart released earnings this week, and everything is going pretty smooth. Before we get into some of the details of Walmart and how they did, I did want to just share this chart and just ask Jared. This is a chart of two companies and how these two companies have performed over the last 5 years. There are no names. So which one do you think is Walmart and which one do you think is Amazon?
Oh, man. The the too much information. I think I know. Let me
Okay.
guess. The 151 is, Walmart.
Yes, that is correct. Good job. Look at you. You're so smart. You're so smart. And so, yeah, so Walmart is up 151% over the last 5 years. It's cumulative return versus Amazon, only up 37%. If I showed the S&P 500, the S&P 500 would be around 71% over these last 5 years. And the next few charts are just kind of comparing Amazon and Walmart. Amazon being the blue line, and Walmart being the orange line. Here we're looking at market capitalization, so the how valuable these companies are. And you can see Amazon's around $2.2 trillion, and Walmart hit the $1 trillion mark. So that was a big deal. That was a couple of weeks ago. It did come down a little bit, but not nothing too crazy. Here is showing just the last 5 years of trailing 12-month revenues, and these companies are generate revenue like no other. So Amazon just surpassed Walmart for the first time, um, making almost $717 billion in 1 year. That's more than you, my friend. I don't know what company you're running, but that is a lot more than all of us. And then Walmart is right behind at $713 billion, and so that was revenue. Here is actually from a valuation perspective. This was quite interesting because when we think about Walmart, we think about just kind of boring, selling bananas, toilet paper, stuff like that. And then when we think of Amazon, we think of innovation and they have AWS and they have Whole Foods and they have the retail and it's and everybody shops there. But you can see here now, Walmart is actually more expensive from a valuation perspective. Looking at trailing 12 months PE ratios or price to
Yeah, that's
earnings ratio,
incredible.
you can see that huge spike there for Amazon, almost 300 PE, coming all the way down to 29. Again, this is not a bad thing because what we're not seeing is return. So even during this last 5 years, as you saw, Amazon still had over almost 40% cumulative return. So still positive returns, even though the valuation came down, and that essentially means that their earnings did kind of catch up to the price. And so this is one way where the valuation kind of looks a little bit better. But from a
Yep.
Walmart perspective, they are more expensive than Amazon. So I thought that was quite interesting to kind of share. A lot of people just thought that Walmart was just going to lay over and have Amazon just take all their market share. But they have not done that, right, Jared?
No, actually, this chart, rather than the other one, was probably I would not have guessed that 45 PE. That just actually blows me away. Seeing that, I haven't seen that in a while. But
Hmm.
no, they're probably doing well because we've been using them. A few of my family members have been using them, and not gonna lie, super helpful, super quick. I mean, same day delivery. If you need wrestling shoes, you need milk, you need eggs, it's there in a couple hours, and so I can see why they've done so well recently. And I was actually listen. What's that?
So you're the reason why it's so expensive.
Like, yeah, I need to buy some stock. But no, I was actually listening to Doug McMillan, the CEO, who's just
Mm.
transitioned to the new CEO, and they were interviewing, saying, you're only 59. Why are you leaving? And so he said the new guy has been running Sam's because Walmart owns Sam's, which competes against
Sam's Club.
Costco, but
Yeah.
does really well. And so yeah, so transitioning to the new leader, and he had full faith that Walmart's going to be a great company. But he had some comments, and one thing he shared that I thought was fascinating was he's like Berkshire was a big investor. They owned stock up until I think 2016 or 2018, and he said when Buffett sold his shares in 2018, he called Buffett and he said, "Hey, why'd you sell your shares?" And Buffett said, "Hey, we underestimated Amazon. I mean, when they're disruptors at heart." And so he's like, it's in my too hard pile. And so that's why he sold. But Doug said, "Hey, I get it. I hope to have a shareholder someday." But so they left on good terms. But I thought that was fun. So,
Interesting.
but yeah, yeah,
So it seems that even the smartest investor that's ever walked our planet Earth, Warren Buffett, still couldn't
yeah.
see the value of Walmart at that time. So it's so hard to pick individual stocks. Berkshire continues to create a ton of value, and retail. Holy cow! I mean, the margins are super thin. You are fighting uh, like a gladiator in an arena. Everyone's like trying to take market share, I understand why Warren Buffett, Berkshire Hathaway, would walk away from that type of deal. It just retails super hard. We see it with Target. Target is
Yeah.
losing market share hand over fist, and it's kind of like it's Costco, it's Walmart, and it's Amazon, really. And Elon Musk recently said that it, you don't create a ton of value by solving easy problems. You create value by solving hard problems. So Doug, Walmart, finding a way and competing with Amazon, competing with Costco, and that was hard stuff. And so kudos to them for continuing to be relevant. This recent earnings call, they did mention that their e-commerce business grew 27% year over year. So
Oh, yeah.
this is big time. And the margins, they don't really break out the e-commerce business, but they did say that their margins are, double digits, and double digits in retail land. It's gold. That's a gold mine. So they're leaning into that. They're leaning into international. A lot of people, even, low income, middle income, high income, they're using a lot of their delivery services, so just to make it easy. I don't remember the last time I went to a grocery store and to pick up food, especially with kids. Man, love kids, enough of kids, but boy, do they just run around like monkeys, and you never know where they are sometimes. And so in the grocery store, I love ordering online, picking it up, going home. Except Costco, I love going to Costco for some reason. I go there for just like their super cheap toilet paper or whatever,
Oh, yeah.
and then I come out with like $300 worth of stuff like that I didn't need. And last time I bought like a suitcase, didn't need a suitcase, but have a suitcase now, and well, I'm gonna start using it. So, anywho,
Yeah.
what's your experience with Amazon and Walmart and Costco, all that, Jared?
Oh, man, well, to speak to Costco, I mean, clothes, every time I go to there, I'm not looking for clothes, but I always end up with clothes and, gadgets and just stuff, so, yeah, uh, going for one thing, leave with 10, so but I did wanna speak on the staples because staples have been on fire this year to date. I believe they're up double digits, but I was actually listening to a money manager talk about staples because they had 25% of their portfolio in staples, and so, anyone would be like, "Hey, that's too much." Because I think there may be 7 or 8% of the S&P. But he said you have to look at it differently. He said for Nestle, if you take Nestle, they're over in Europe, and he said that they have been flat for a year. Think about that. How holding a stock and it's flat, doing nothing. But he said, they changed the portfolio. They're making changes. I mean, even if they're growing from they were growing at 4%, now they're growing at 6 to 7% plus a 4% dividend. You're getting 10 to
Mhm.
11% of return with very little risk. And so when you think about risk, I mean, that's a pretty good trade-off. I would take 10, 11% in a pretty safe name. So I mean, Staples, that's why you're seeing that go up so much because I mean, Walmart they're competing against, Costco, they're also competing against Amazon, so, they're a staple very much for sure, and so,
Right.
people see that, and that's what you see. People are voting with their shares, so
Mhm. And for those in the crowd, consumer staples sector, that's what we're talking about. These are companies that produce essential non-cyclical goods like food, beverages, household products, toilet paper, bananas, those types of things that you just buy all the time. So that's what we're talking about here. There's always risk in investing in individual companies, much more than buying a diversified
yeah.
index for sure. But these consumer staples, utilities, these boring companies that continue to buy back their stock or pay dividends or just grow 1 to 2% per year. That's what we're talking about. That's more defensive sectors versus the high growth. Information technology comes to mind. There's risk in of all the individual
Oh, yeah.
companies, but there's less volatility in the price. I think
Yeah.
that's what we're talking about
Yes.
here, and that's what I also want to focus on. There's a really great chart by Bespoke just showing the massive volatility that we're seeing in the marketplace right now. There's a lot of storylines happening, but this chart really stood out to me, breaking out the number of companies that are uh, have over 20% returns and less than 20% returns year to date. we're just talking about year to date, short term, a bunch of nonsense, over time, staying invested with the discipline plan. That's what we believe works and creates value over time. But just talking about the short term, there's massive volatility happening. This is as of February 17th, so a couple of days ago. But still, 119 companies now are plus 20%, minus 20%, and very few are in that kind of more than 5%, less than 5% range. And so it's kind of interesting just to see just a huge dispersion right now in those companies that are above 20%. A lot of them are energy companies. There's several industrial companies, lots of tech companies for sure. So there's big winners happening in all sectors. Maybe this is the year that individual pickers can add more value than the index. This is a big reason why staying low cost, diversified index um, tends to win out over time because it's really hard to pick the winners. And there's a lot of narratives happening. Is software done? Is private credit over with? Is our energy companies a new bull market? With the situation happening in Iran, what about with the Supreme Court shutting down the tariffs? Is that going to be positive for the market right now? That just happened today, and the market was up today.
Almost a
You
percent.
know, yeah,
Almost a
yeah,
percent.
yeah. And so there's, talking about Costco, there's 1,000 companies or roughly something like that sued the U.S. government to get refunds for those tariffs. And Costco was one of those companies. And so, that was always a bigger tax. The Federal Reserve came out with a study that showed the tariffs was a bigger burden for U.S. companies than outside suppliers. But again, U.S. companies, even though they had to pay those tariffs, guess who has the highest margins? U.S. companies. They continue to have uh, the best margins. They are some of the most innovative companies in the world. So it's never good to bet against America, just like what Warren Buffett said during the 2008 financial crisis, and that was kind of a buying opportunity from that standpoint. What do you think about all of that, Jared?
No, and actually volatility, I was reading about that this week. And one thing that I thought was interesting is there's been a heavy inflow to multi-strategy funds or for those hedge funds. So a lot of people they're taking longs and shorts, so they're betting against the market. So that might be an increase in volatility. Is we have a lot more people betting for those momentum stocks, the ones that are going up really
Uh,
fast, the
uh,
staples, the industrials, but also a lot of people that are betting against other companies, so they're making them going down a lot more. So I thought that was fascinating because it was the highest inflow since 2020. So it just shows that people are a little more cautious, especially with all the AI spending, thinking it may
uh,
be a little high or overdone. That's to be seen. We're long-term investors, so but always be cognizant of how people feel. So the hedge fund accelerator or the hedge fund accelerator. So yeah, so it's interesting.
Yeah, for sure. Okay, with that, our last segment, as we always like to end the week, is wisdom of the week. I always like to share like an idea that I read from a book. Harry Truman says, "Not all readers are leaders, but all leaders are readers." And so I got a couple of people that have told me to read a lot. Besides my wife, Warren Buffett and Charlie Munger, that's what that's what they spent most of their time doing. And so this week, I finished a book called "Payoff: The Hidden Logic That Shapes Our Motivations" by Dan Ariely. And so he just talks about like the how to destroy motivation, how to lift people up, and it's not just about money. There has to be some meaning behind what we do, you know. And the example that I got that kind of stood out to me was a story with a factory with Intel. The book was written almost like 8 9 years ago or something like that. So, but Dan and some of his colleagues went to Intel to measure the productivity of four different groups. So they put a couple of employees in these different groups. Three of them were got a reward for the work that they received. One was a control group; they didn't receive any reward at all. Okay, and so the reward was one got more cash. depending on the work that they did. One got a pizza voucher. A pizza voucher, that stinks, but they couldn't give them a real pizza because of Intel's policies, which is kind of weird. And then the third one was a compliment from their manager, just saying, "Hey, I appreciate what you do. I value what you do." And so they got those. They got the reward the first day, and they only got it on the first day. Okay, and then they measure productivity over a week. So after the first day, giving those rewards into to those three groups increased productivity the first day versus the control group that didn't receive anything at all. So giving somebody some type of acknowledgement, you get something back. But over the week, what was interesting that Dan and his colleagues found was that those who received a cash reward, their productivity over after a couple of days decreased by 13%, worse than the control group, which didn't receive any type of reward. And this is because Dan and his colleagues found that if I was not going to get rewarded for something, it became transactional. So why am I going to do this if I'm not going to get a bigger bonus? And so, but what they found from the group that did receive an actual compliment, their productivity continued to improve versus the control group that didn't receive any type of reward. And the pizza voucher was kind of in the middle. It's so funny. So giving somebody pizza is actually better than giving them an actual cash bonus. So again, this was kind of a one experiment that they used, but there are several examples in the book. Enough to say that this is from the book. He says, meaning has to do with having a sense of purpose, value, and impact, of being involved in something bigger than the self. And so money pays the bills, so to speak, but it doesn't lift us to a greater calling. And so this is probably something that people on different life stages, maybe if you're starting to begin your career and you're thinking about, I want more money, maybe it's not about money, maybe it's about having autonomy, maybe having to learn from people that you admire. Maybe those are the type of rewards you should be looking at. And at the end of your career, maybe it is something like, hey, uh, maybe I don't want to just clock in, clock out. I want to leave a legacy that has something with meaning. And the first person I think of is Mike Leatherman, who's our CEO, and he wanted to do something. He's last chapter, so to speak, and he wants to do something meaningful, and he's here with us. Very grateful for Mike and his leadership here. And Jared, what do you think about that?
Oh yeah, man, that was incredible. Yeah, no, and now I got to read that book. That's incredible.
Yep. Okay, with that, my friends, that is all we have for today. If you have any questions, please shoot them at us at lwp@nm.com. No bots are reading those. Real people, real answers, all that good stuff. And we look forward to seeing you guys next week.